What is the dual mandate in inflation targeting history? Imagine a central bank trying to walk a tightrope where they need to keep prices stable while also helping the economy grow strong and full of jobs. That's what the dual mandate is all about. It's a key part of how the Federal Reserve, the United States Central Bank, guides its decisions. The dual mandate means they aim for two main goals at the same time: maximum sustainable employment and stable prices. This means they want as many people working as possible without causing prices to rise too quickly. They usually target an inflation rate of about 2% per year, measured by the Personal Consumption Expenditures Price Index. This approach was officially written into law in 1977 through an amendment to the Federal Reserve Act. Before that, the goal of maximum employment was already set by the Employment Act of 1946, which said the government should promote full employment. Price stability was understood as keeping the value of money steady, so inflation wouldn't eat away at savings and purchasing power. The 1977 law made it clear that the Fed should focus on both goals, but they are often seen as two sides of the same coin. The idea is that stable prices and high employment support each other. In inflation targeting history, the dual mandate influences how the Federal Reserve sets its policies. They adjust interest rates and other tools to balance these two goals. When inflation gets too high, they might raise interest rates to slow down the economy. But if unemployment is high, they might lower rates to encourage spending and hiring. Sometimes these goals conflict, and the Fed has to make careful choices. For example, if inflation is above 2% but employment is very high, they might hesitate to tighten policies too much. Conversely, if unemployment is high and inflation is low, they might loosen policies even if inflation starts to rise a little. This balancing act has shaped the way the Fed approaches inflation targeting. Unlike some other central banks that focus mainly on price stability, the Federal Reserve sees both inflation and employment as equally important. They believe that a healthy economy needs both stable prices and a strong labor market. This dual focus guides their decisions and helps them aim for long-term economic stability. So, in simple terms, the dual mandate is the Fed's promise to keep prices steady while also making sure as many people as possible have jobs. It's a careful balancing act that has defined much of the history of monetary policy in the United States.